In the high-stakes world of finance, fortunes can rise and fall with breathtaking speed. Few stories illustrate this better than the dramatic collapse of Archegos Capital Management in March 2021. At the heart of this financial tempest was Bill Hwang, a man who quietly amassed a fortune capable of rivaling Wall Street's giants, only to see it evaporate in a matter of days, costing the market a staggering $100 billion. Bill Hwang's ascent was anything but ordinary. Born in South Korea, he immigrated to the United States, where he pursued higher education, earning an economics degree from UCLA and an MBA from Carnegie Mellon University. His career took off at Hyundai Securities in New York, eventually leading him to Tiger Management, a prestigious hedge fund run by Julian Robertson. Hwang became one of the Tiger Cubs, a group of Robertson's protégés who achieved significant success. However, Hwang faced setbacks, including a ban from trading in Hong Kong due to insider trading allegations in 2012. Undeterred, he founded Archegos Capital Management in 2013, employing a bold strategy, using borrowed money to make aggressive stock bets. His weapon of choice was the total return swap, a complex financial tool that allowed him to take large positions without directly owning the stocks. This approach propelled him to great heights, but also sowed the seeds of his downfall. As March 2021 progressed, cracks began to appear in Archegos' financial structure. Hwang's heavily leveraged positions came under intense liquidity pressure. His concentrated bets included major stakes in companies like Viacom CBS, Discovery, and several Chinese tech firms. As these stocks' prices fluctuated, the value of Archegos' positions became increasingly volatile. Margin calls surged in, demanding billions Hwang couldn't provide. The situation spiraled rapidly. On March 26, 2021, Archegos defaulted, prompting a frantic sell-off by banks like Credit Suisse, Nomura, Morgan Stanley, and Goldman Sachs. The financial world watched in disbelief as these institutions reported losses exceeding $10 billion, highlighting the fragility of a system built on leverage. The aftermath of Archegos' collapse was swift and severe. Investigations and lawsuits targeted Hwang and his associates, with charges of fraud and market manipulation. Regulators worldwide scrambled to comprehend the full extent of the disaster. The U.S. Securities and Exchange Commission launched an inquiry into whether Hwang's activities breached securities laws. Once a discrete powerhouse, Hwang now faced public scrutiny and legal repercussions. In April 2021, he received an 18-year sentence, serving as a stark reminder of the hidden dangers in high finance. The impact extended beyond financial institutions. The human cost was significant. Employees and stakeholders of affected banks faced layoffs and uncertainty. At Credit Suisse, the fallout led to resignations among top executives and a major overhaul of its risk management practices. The reputational damage rippled through the industry, sparking debates about risk management and regulation. How could one man's actions lead to such widespread devastation? The Archegos debacle's root causes were multifaceted. Excessive leverage was the linchpin, amplifying losses when the market turned against Hwang. A lack of transparency obscured his operations, allowing him to operate under the radar. The use of total return swaps meant his positions weren't disclosed like traditional stock holdings, enabling him to accumulate massive, undisclosed stakes. Regulatory gaps in managing derivatives like total return swaps meant risks were hidden, leaving financial institutions vulnerable. The incident served as a wake-up call for regulators, who realized the opacity of the derivatives market posed significant systemic risks. Following the collapse, financial regulators worldwide began re-evaluating their oversight of derivatives trading and leverage. The Federal Reserve and other regulatory bodies conducted reviews to assess the vulnerabilities exposed by the Archegos incident. A renewed emphasis on transparency and risk management emerged, with calls for stricter reporting requirements for derivative exposures and enhanced scrutiny of prime brokerage operations. The collapse of Archegos Capital is a cautionary tale. vividly illustrating the dangers of unchecked leverage and opaque trading practices. It has prompted urgent calls for reform, with regulators and industry leaders pushing for more stringent oversight to prevent another Archegos from taking root. The financial world must grapple with the lessons learned, ensuring accountability and robust risk management to safeguard the future. For Bill Hwang, the personal toll was immense. The son of a Korean pastor, Hwang was known for his philanthropic efforts, contributing millions to Christian organizations and educational charities. His fall from grace was not just a financial catastrophe, but a deeply personal one, shattering the image of a man driven by faith and success. Friends and former colleagues were left to reconcile the man they knew with the reckless trader who had brought Wall Street to its knees. Ultimately, the fall of Bill Hwang and Archegos Capital serves as a stark reminder. In the world of finance, fortunes can be built on borrowed time, but they can just as easily be swept away by the tides of fate. As the dust settles, the lessons of Archegos continue to resonate, urging a more careful consideration of risk, transparency, and the true cost of unchecked ambition in the financial markets. The scars left by this financial implosion will not fade quickly, serving as a testament to the perils of a world where fortunes hang by a thread and the line between success and disaster is perilously thin.